Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about stock splits, reverse stock splits, and stock buybacks, what each of them are and how they might impact your investments. Let's get right into it. A long-term investor will likely have encountered at least one of these events at some point in the past or future. A short-term investor might look to trade one of these events for a quick potential profit. Stock splits. A stock split is where one share of stock splits into multiple shares and reduces its stock price by the multiple of the split. The best way to illustrate a stock split is asking for change. If you ask someone for change for a $20 bill and get two $10 bills, you still have $20, but with two bills instead of one. The total value remains the same, but you end up with more bills. A stock split works in exactly the same way. An investor would own more shares once the stock splits, but the total value of the shares would not change. They don't have to be in exactly a 2-to-1 ratio, which is what was in the change example I just gave, where you would get 2 shares for every 1 share you own. Apple recently did a 4-to-1 stock split on August 31st, 2020, as an example of a stock split that was greater than 2-to-1. If you owned 100 shares of Apple stock before the split, they would turn into 400 shares after the split. Splits are generally a good sign for the stock since prices can grow so high that the stock may be out of reach for smaller investors trying to maintain a diversified portfolio. It becomes difficult to own even one share of a stock sometimes, with a common example being Amazon at over $3,000. Without a stock split, investors have to depend on fractional shares to diversify their portfolio and invest in some fractional shares of a stock like Amazon. Investors who own a stock that splits may not make a lot of money immediately, but they shouldn't sell the stock immediately either. It may take some time for the price to appreciate either before or after the split. Generally, once a stock split is announced, investors tend to buy shares before the actual split in the hopes to get additional shares to hold for the future. Sometimes there is a slight dip or drop in price right after a stock splits from some investors or traders taking some profits and selling their shares on the price appreciation between when the stock split was announced and once the stock actually splits, which is called the split adjusted basis. Stock splits are more of a positive indicator for the direction of a stock and may be a reason to buy shares in a company, and reverse stock splits are more of a negative indicator for the direction of a stock and may be a reason to sell shares. Reverse stock splits. A reverse stock split is where one share of a stock splits into fewer shares and increases its stock price by the multiple of the reverse split. Inversely to a stock split, reverse stock splits work the exact same way, except backwards. Going back to the example with change, if you ask someone if you could exchange two $10 bills for one $20 bill, the total value again remains the same, but you end up with less shares that are a higher price. When a stock's price gets low enough that the company doesn't want to get delisted from a stock exchange or look like a penny stock, they sometimes pursue a reverse split. Reverse stock splits have historically performed poorly for companies that do this. An example of this is Helios and Matheson Analytics, or HMNY, better known as the owner of MoviePass, which performed a reverse stock split in 2018 in an attempt to stay listed on the NASDAQ. After their acquisition of MoviePass, they were losing a ton of money, and investors were running to the exit selling shares rapidly. They performed a reverse stock split at 250-to-1, meaning for every 250 shares an investor would only have one share. They ended up getting delisted and moving to OTC or over the counter because they fell into penny stock pricing and have stayed there since. Earlier in 2020, they filed for Chapter 7 bankruptcy. Take a cautious approach around companies that are interested in reverse stock splits. Stock buybacks. Stock buybacks are when a company uses its cash to repurchase stock from the market. This lowers the number of shares outstanding, which increases the value of each share available temporarily in the open market. Microsoft is a company that buys back their stock from time to time. Companies will often buy back shares of their stock, assuming they see their stock as undervalued because they have a strong balance sheet with solid fundamentals and plans for growth over the next several years. Sometimes what companies will do is issue new shares at a higher stock price several years after the buyback of shares in the hopes of raising more capital by issuing new shares at a higher stock price, and therefore gaining the difference in stock price. An example would be if a company's stock is $70 in 2020 during the stock buyback, and the stock price increases to $90 in 2022, the company would gain the difference in capital of $20 multiplied by however many shares they reissue. This outlook for a buyback can be seen as a positive signal for investors. A negative signal for investors can sometimes be a buyback of shares because a company may want to make certain metrics look better, like PE ratio or EPS, when nothing material has changed. The price to earnings ratio relates to a company's stock price to its earnings per share, but when you reduce the total number of outstanding shares, both ratios improve. A high PE ratio could mean that a company's stock is overvalued, so by reducing the number of shares, it makes the PE ratio lower. EPS, or earnings per share, is calculated using a company's profit divided by the outstanding shares of its common stock. A more mixed view of stock buybacks can be that they would be shrinking the company instead of expanding the company by lowering the amount of shares outstanding. When shares of a company are lowered, they effectively lower their market capitalization and use money that could have been used in other efforts to further grow the company or do research and development. It comes down to interpretation on how investors might view any buyback of shares scenario. Making money on buybacks can be tricky, and I would not recommend buying shares in a company just due to this specific event. Look into the fundamental impact to the company for any buyback and see if the reason that the company gives for the buyback matches the impact and otherwise makes sense. Please do your own research or consult a financial advisor, CPA, and accountant if you need help with any investing around any of these events within your investment portfolio. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.